So, about a month ago, Apple and Tesla decided to split their stocks, and that went into effect like last week. I've been getting some questions around stock splits, so I wanted to go over what a stock split is, why do companies do it, and if investors can get any benefit from it. A stock split is pretty much what it sounds like. It is when a company decides to split its existing shares into more shares. They are basically multiplying the number of shares by a certain factor and dividing the price by that same factor. For example, with Apple, they did a 4-to-1 split. What that means is that the number of shares were multiplied by 4 and the price of the share was divided by 4. Let's say you had 10 shares of $500 each. You would now have 40 shares at $125 each. Ultimately, the amount you have in Apple is still the same at $5,000. And a lot of people think just because you get more shares that somehow you're better off financially. Well, consider a pizza. Now let's say that pizza is split in 4 pieces and you get 1. Is that any better if the pizza was split into 8 pieces and you got 2? The answer is no, because you get the same amount. However, if it was split into 8 pieces, you had an option to get 1/8 of a pizza, which you didn't have in the first case. So imagine a company that has 1,000,000 shares at $100 each. That means the company is valued at $100 million. Now, if a company splits its 1,000,000 shares to 2,000,000 shares, which also means the company's stock price goes from $100 to $50 each, does that change the value of the company? And the answer is no, it's still valued the same at $100 million. So if you're a long-term investor, you should realize that splitting the stock of the company in any way doesn't change any performance or the fundamentals of the business. And if you are a long-term investor, that shouldn't really change your view on buying the stock long-term. And it doesn't really matter how many shares you have. What matters is how much money you have in the company. If I own 1 share at $2,000 or 100 shares at $20 and the company's value goes up 10%, I make $200 in both cases because the amount was the same at $2,000. So a stock split may reduce the stock price and make it more affordable, but that doesn't mean the company is cheap and you should buy, because it doesn't change the value of the company. But if that doesn't really change anything, why does a company bother even splitting its stock? A company typically splits its stock when the share price becomes too high for some investors. Let's say you had $1,000 that you could invest and you really like Tesla. Well, before they announced their 5-to-1 stock split, their shares were trading around $2,200. So you couldn't buy 1 share because you just had $1,000. Well, now you can, because after the split, each stock is worth around $440 instead of $2,200. This is the main reason companies split their stocks, so they can attract investors that just want to buy a few stocks without putting in a big sum of money. And if you look at Apple's and Tesla's press releases, you'll see that it's the main reason that they decided to split their stock to make it more accessible to a broader range of investors. However, stock splits are not as common as they used to be, and it may be due to the invention of fractional shares. Another reason for the split could be for more liquidity. By liquidity, we really mean more trading, and that makes sense because there are more shares now. And that matters because you want to buy or sell the shares closest to the market price you see on the exchange, and because you want to make sure that there's someone buying what you're selling or the other way around. Both of those reasons are probably good, so why don't other companies also split their stocks? Why does Warren Buffett's Berkshire Hathaway's Class A share cost almost $300,000? Well, according to Buffett, high prices attract like-minded people who are focused on the long term. Another reason is that a high stock price may have a perception of being more prestigious or valuable to the public, which isn't a bad thing for the company. Some other companies may avoid stock splits if they think the price of the stock could fall too low, which may not attract some investors and have a perception that the company isn't that good. Or because they may think that it could fall below what the exchange requires to be listed. If that price falls below a certain amount, they risk being delisted. In this case, companies can do what's called a reverse stock split, which is the opposite of a stock split. Shares are divided and prices are multiplied by a certain factor instead of the other way around. Bottom line though is stock splits or reverse stock splits should really not be the reason you invest in a company for long term. Now, you may think that, well, when the stock splits, there is renewed interest for investors as more investors can now invest in the company. Well, that is true. But think about what could happen. As new investors buy more, the company's value would go up, but as it goes up, some other investors may think that the company is overvalued because nothing has changed about the business, and it's going up in value, at which point people may start selling and the company may come back to its fair value. The point is, when the stock splits, the value of the company is the same. Nothing has changed about the business fundamentally, and if you're looking to become a long-term investor, there should be a better reason for you to be an investor in that company. Just looking at the price is not investing. Hopefully this video makes you realize that just because the stock is affordable does not mean that it's a good stock to buy. A $1,000 stock could be a better purchase than a $50 stock. Thank you for watching. And by the way, if you guys don't know where to start looking but want to get into the stock market investing, a good place to start may be my video on Intro to Stock Market Investing.